Welcome, ladies and gentlemen, to the 6-month deep dive analysis of my $282,000 stock market investing portfolio. We're going to be taking a look at the positions, how I feel in the current market environment, and what the latter half of this year might look like. Because you've been buying dividend stocks, you've been getting absolutely terrorized as interest rates have really continued to drag a lot of these down. Whereas if you're a tech-oriented investor, you like the Qs, the S&P, you've been crushing it. I mean, I've been feeling a lot of the gains here, and I want to give you a little bit of hopium, some optimism, because I'm seeing a lot of fear, especially with tech investors, S&P investors, because they keep reiterating that the price to earnings multiple is getting a little bit high. And I told you, even though I might feel the markets are a bit overvalued here, you can't stop buying, because what you're going to notice here is if you look at the price to earnings that peaked in basically December of 2020, where we almost hit a 36 times price multiple before it collapsed all the way down to March of 2022, where it hit a 22 times multiple. I want to show you, or a 20 times multiple actually. I want to show you what you missed out on if you weren't buying the peak of the market in December of 2020. If you take a look, during this period where the price multiple went skyrocketing and then collapsed, the actual S&P was running obviously during this period, and when it collapsed to the lowest multiple we saw, that all happened in this little time period right here, and you would have still been up by just a half a percentage point if you bought the peak of the multiple in December of 2020. And if you bought the peak of that multiple today, you'd be up 50%. So it really goes to show that it's just the mood swing of stocks that will ebb and flow out of the S&P 500. And we're going to take a look at these because, firstly, the S&P is my largest position. It is 56% of the portfolio. I think in totality right now I own about 230 shares. It's not where I want it to be. My goal is to get that up to probably a couple $100,000 position. Right now in the Canadian conversion, it's worth about $158,000. And in fact, but the largest VOO position I hold is in my corporate account, where I'm shocked that it is up 31%. My initial cost is around $60K for 159 shares in this account, and we were up $19,000 in gains, which it's crazy how fast time blows by and how much opportunity you miss out on even just buying broad-based ETFs. So we'll start with the S&P, how I feel about it, and then we're going to break down my other positions with SCHD, VDY, and obviously Tesla here, which I finally finished up my first 100 share position. Bought those shares this week. We'll take a look at where that sits because I think the price is coming down a little bit. But when it comes to the S&P 500, a lot of people think there's some crazy overvaluation metrics, and to some extent there is, because I would say Apple's not growing like it was. Nvidia's been on an absolute tear. If that continues, it could continue lifting the S&P. It's been a huge contributing factor to a lot of that. But let me break them down by revenue and how I feel about this higher price multiple, because Apple is, the second largest company right now, and it has had very nominal, actually stagnant to no revenue growth at all. They really need basically an AI push. They need a whole new cycle of phones to get people buying again. But I think this is a sign of the cyclical nature of higher interest rates, because they've been buying shares and they've been able to keep their net income fairly strong. Microsoft has been back to where it was post-pandemic levels. I mean, if we stay at these levels of growth continually at the scale of these companies, not only are they eventually going to become monopolies, which they already are, but they're going to continue to lift the entire market and continue to show this technological shift is still happening. I mean, when you get Microsoft at the scale of the revenue it's generating, growing at a 17 to 20% pace where it was during 2018-19 heading into 2020, there's no reason that it doesn't deserve a 30 times multiple, right? You look at Nvidia here. Nvidia, I still think, is going to be very cyclical in nature, because eventually these big tech companies will either start producing their own chips. They're going to find another means where they're not paying so much for them. That's been my argument, because they just introduced their own AI chips to make up for the supply slump that Nvidia's offered to them. But for now, I mean, if this keeps up, by all means, Nvidia is going to continue to tear, right? Amazon has been stagnating since 2022. And when I mean stagnating, again, they're generating an absurd amount of revenue. But to be in the double digits isn't exactly where it was if you go back even to 2016, 2018. Like, it was always hovering around 20% growth. And it looks like it's fighting to get back there. But when you're making a $590 billion, even increasing 12% year over year is insane. I mean, that 12% is a lot higher amount of revenue than it would have been in 2016 when it was growing at 31%. So that's expected. Amazon can still still pull a high multiple for the value that it's offering. Meta here, one of our favorites, one of the largest positions in my fiance's portfolio, is coming back with a vengeance. Revenue growth in the mid 20 percentile range, nuts, absolutely bonkers. So, they're definitely helping pull the S&P. Google here, I've been bearish on Google. I sold my personal position in it just because I'm more worried about competition with search and AI. But obviously, Google, I still think has a great runway ahead of it. Doesn't mean it's not going to perform well. I would just rather place my personal larger bet with Tesla. But hey, Google's going to keep doing well here. I think if it can get back into the 20% range and start matching the growth of, say, Meta. But keep in mind, Meta is producing like half the revenue. It's a little easier for Meta to grow than it is for Google at this scale. But Google's still holding up at 15% revenue growth on those last earnings. Even Berkshire, for crying out loud, a holding company. They're not growing insanely like they were. They probably cash returns went exuberated because insurance companies are benefiting so greatly from a higher interest rate environment because they have so much cash. They're putting it in cash accounts. Berkshire's, they were growing at a 19% last quarter, about 5%. Still, absolutely incredible. This is the top 10 company, which just further gives you exposure to Apple. Let's be real. Finally, got like Eli Lilly kind of pulling up here, which is really interesting. You see these bottom half of the S&P stocks swapping up pretty regularly these days, but Eli Lilly has been growing at an absolute tear as well. And when I see these double-digit growth rates, I understand why we're seeing multiples on the S&P that are in the 20 to 30 range. This isn't like the dot-com area or 2008. These companies are absolutely crushing it. So there's no reason for us to go back to a historic median of 15, which is why I hate when you see value investors trying to compare it to GDP and all this stuff. There's so much future margin expansion you need to be paying attention to that's going to continue to happen. It's going to be very volatile. I think my biggest prediction in the market is we're going to see more volatility than we have in the past. After the 2008 crash was one of the most stable markets we ever experienced. And I think from here, it's going to be very volatile. We're going to see a lot of ups and a lot of downs, but the overall trajectory should continue to be up to the right because that's just what earnings and GDP is demanding. It's really demanding that from the market. So what does it say for the rest of the positioning, right? Because I'm obviously a tech-oriented investor, and when you look at things like SCHD or VDY, there's a lot of concern because they have just not been keeping up with the market. I mean, SCHD is up 1.43%. We're 6 months into the year against the S&P that is currently up 15.79%. Now, you want to keep in mind, I am holding these investments for very different reasons, and I want you to really closely pay attention to the weightings because my dividend-oriented investments like VDY and SCHD don't make up much more than 30% of my whole portfolio. And I've been buying these not only to collect income because it's great to have income and it was very appreciative when the markets weren't doing so well. When the markets took a massive dip from 2021 and you really didn't see a return till basically 2024, this period was a great time to collect dividends and reinvest. You would have done substantially better with some dividend-oriented companies. That's why I like having some income backing up, the total portfolio. But at the end of the day, these are recovery plays. These are interest-affected oriented stocks. I mean, Home Depot at the top of the list here. Home Depot's revenue has been stagnating since 2022, right? You got things like Cisco in here. It's starting to pull back a bit. AbbVie hasn't been doing as well as some of the other, big conglomerates in healthcare, but there's so many good companies in here that I still think are incredible, that have good recovery, good moats. They're not going anywhere anytime soon. Coca-Cola, BlackRock, you got UPS in here. Verizon, I think, is incredible. Texas Instrument, Pepsi's obviously a huge gem, and Pepsi hasn't done anything either, right? Like, if you've been a solid Pepsi investor, what have you gotten for the year to date? Nothing. Leave minus 5%. You zoom out on 5 years, the growth's been a bit stagnant here, right? But I still think these are profound companies that I like having in my portfolio that kind of upperweight the bottom half of the S&P stocks that I might not have that much exposure to. Kind of equal weights my VOO position a little bit more. You just got to understand that a lot of these companies have just been in the gutter. Pfizer, I mean, Bristol Myers, Altria Group, I don't like that much, but hey, I'll put up with it to have the diversity. Kimberly-Clark's in here. Hershey, another one that I absolutely love that's been just trading down horrendously. So when it comes to SCHD, you kind of have to have a long-term perspective on this, and you have to have some belief that these companies have the ability to recover and that they are, companies with moats that are huge name brands. They're not small companies, right? And if you kind of clash that with VDY, and I love these two investments combined, VDY and SCHD together, kind of give me the best of what I consider to be dividend stocks that I would buy on an individual basis, because VDY is only up 1.65% or 1.59% now as of year to date. And a lot of people are kind of giving up on the Canadian economy, and I've I've kind of been talking a little bit of crap about it. Canada's been in the gutter. TD's just been taking a shit kicking. Royal Bank's been doing okay, but I really love that this is a passively weighted ETF, and it just gives me exposure to the largest companies Canada has to offer that pay the best yields, that have the highest consistency and moats, like Enbridge. You really think Enbridge, it is the lifeblood of the Western world. It is the largest pipeline company globally. They're getting huge exposure to natural gas. Like, they have such good investments and income. Same with Toronto Dominion Bank. It's getting beaten to the ground. Like, when I buy this, I put every $1,000 I put in here, I'm getting about $100 exposure to Toronto Dominion Bank, and I really preferably just want bank exposure. So I like that this is largely weighted in the Canadian banks, but you get Manulife, Canadian Imperial, TC, and there's so many good companies in here. So I feel like parroting these together just to kind of, it'll average my income out to probably closer to 4% on average, and I'm very comfortable with that. I just need to get a little bit more VDY. I'm still looking to scale it. I still think there's going to be a lot of recovery in those kind of stocks. And I think they're largely being underappreciated in this market environment because we don't know what the market's going to look like in the next 1 to 3 years when the interest rates start coming down. And they will start coming down. So you have to kind of find yourself in a balance of these camps. I honestly don't think it's appropriate to be all-in growth stocks because there's periods where they just get wrecked. And I don't think it's appropriate to be all-in dividend stocks because you miss out on the capability of total return. So that's why I very seldomly buy individual stocks. I have some small caps and some crypto, of course, but at scale, the only stock I bought super aggressively has primarily just been Tesla. I feel like Tesla has the greatest growth opportunity ahead of it, incomparable to a lot of these companies like Microsoft or Apple. I think they've kind of matured a lot. They need cycles to grow, whereas I think Tesla, if we just be patient with it for the next 3 to 5 years and some of these growth vectors come into fruition, we could easily see this stock double or triple, quite a bit more, offering much more substantial returns perhaps than some of the other mega companies that exist, or the Mag 7 that Tesla is no longer a part of. So yeah, I ended up picking up my last several shares this week. Now I've got 100 shares at a decent average price, I think of about $186 a share. I told you guys I wanted to get the initial 100 shares within the $100 range, and I'll play it out by ear. If earnings come in or deliveries come in next week and they're missing on that and the stock drops, gives me an opportunity to buy a bit more. I don't think earnings are going to be great. As I said, I think the real recovery for this company is going to be 2025 to 2027, but we shall see. I place my money where my mouth is, as I do transparently with you every week on my path to financial independence, to perhaps one day retire early, desperately fighting to get over that 300K mark by the end of this year. And if you're on this journey with me, I would definitely consider subscribing because I'd love to know what you're buying, what you think about the markets, and how you feel in your portfolio for the 6 months of this year. Do you like the dividends? Are you buying growth? Tell me everything about it. Stay cool. Stay awesome, folks. And as always, I look forward to catching you in the next one.